Okay, so our lesson, we are starting a new lesson today, and it is bad debts and provision for bad debts. So this is a new topic, but we are going to start with the bad debts first. Because bad debts, what are bad debts? This is what we have in your books, right? Bad debts are debtors or receivables of an accounting period that will likely not pay the amount owed, so it is written off by the company or business as an expense in the income statement, thus reducing the net profit. Bad debts also decreases the value of the outstanding receivables accounts. A bad debt is usually a result of the debtor going into bankruptcy or where the additional cost of pursuing the debt is more than the amount the creditor could collect. So that is a lot that we have for our books, for our workbooks. What we're going to do is kind of break it down into parts, because you would have gotten about 3 things from that entire paragraph for bad debts. It's an expense. It decreases the amount in the receivables account, and it is only written off, the debt is only written off when you really have exhausted all possible ways of collecting that debt. Okay? So accounts receivables and bad debts. You have our inventory. So a business sells inventory. They may sell it on credit. And when they sell that inventory on credit, you create an accounts receivable or a debtor. They now owe the business money. So they owe a debt. So basically, they are supposed to pay the amount owed sometime in the future, whether it be a month, 2 months, 3 months. And reminder, when we had done cash book, remember there was something called trade discounts. You trade discounts with discounts given to encourage the receivables to pay the amount that they owed faster, because we want to collect our money faster, because the more you go into the future is the higher the risk that they may be unable to pay the debt, which is why we are here now with this topic. What if that receivable is considered uncollectible, meaning that we have exhausted all ways, he is bankrupt? It makes absolutely no sense to pursue the debt, because some of you might say, take him to court. But the lawyer fees and the court fees and all of that you would put out, is it really worth it going after somebody who really does not have that money? In fact, even if you get that debt, you may have paid more in terms of lawyer fees and court fees and debt collector fees that would outweigh the fact that you collected money, right? Just think about it. You pay $2,500 to collect a debt of $1,000. Makes absolutely no sense. So what if it becomes uncollectible? What the business will decide to do, it becomes very necessary for us, the business, to write it off as what we call a bad debt. And as we said before, it's not just that we writing it off just because of good faith, but it really does not benefit us to pursue, that debt. It really doesn't. Many of you would have the experience where you lent money. So you lent your money, and we have this culture, lend me $5, lend me $10, lend me $100, and this time you're really in plan on paying it back. Or even if you lend it, you might not be expecting it because of that culture. But say you lend somebody $100, or you have lent them the $20. Let's go smaller. $20, and then you go to them every day and you're asking for your money, and every day is an excuse, until eventually you ball, whatever, forget it. And you stop going after the person, you stop asking. In your mind, you go, whatever. The whatever is the equivalent of the business saying, I am writing off that debt. It's like you're taking the loss then, because it really makes no sense to continue pursuing the person. It looks like you ain't going to get that money, right? So for a business, the business will weigh the cost and the benefits, and it might be wasting their valuable time and resources going after that debt, especially if the debtor or receivable is bankrupt. Now, another thing, when we say that a receivable is bankrupt, this is a legal thing. Is not any and everybody that just come and say, hey, I can't give you your money because I'm bankrupt. No, bankruptcy is ordered by the court. So whenever the court claims or says that you are bankrupt, that is legal, and therefore the business will know that this is true. It is legal, and then they will make the decision, well, okay, we are going to write off that debt because he is bankrupt. Legally, the courts have stated it, and therefore we are not going to get that money. Write it off as a bad debt. So this would be your notes, and since this is a video, you can take the notes, you pause the video and you take your notes, so I don't have to wait on you guys and do the whole 10 minutes thing. Yeah, I know I'm exaggerating, but your heading would be Bad Debts, Workbook, page 242. And what you're going to write, bad debts are debts written off by the business when a receivable is unable to pay and the business has exhausted all ways of getting the money owed. So that is what we went through with our long explanation and stuff like that. They exhausted all of it. Person is bankrupt. They're legally bankrupt. The courts have stated it. So therefore, you're not going to get your money. You write it off as a bad debt. Like you would say, whatever. Okay? Bad debts are recorded as an expense in the income statement. So first major point, bad debts written off is a loss to us. It is an expense. It is recorded as an expense in the income statement when we are calculating our net profit or loss. Okay? As an expense, the bad debts account or the T account, if you remember your double entry rules of Alice, assets, liabilities, income, capital, expense, and the accounts, when it increases for assets, debit, liabilities, credit, income, credit, capital, credit, and expenses are debited. So because the bad debt is an expense, that means every time you write off a bad debt, the bad debt account is debited. And remember what that means? It means that you go on the debit side of the bad debts account and you write the information there. So this is what your bad debts account would look like. In our slide, we have our debit side in blue. So we have it in blue there. No, your accounts are not going to be colored. I just did this for you guys. So your debit side in blue, and this is the side that you're going to go and write your information on. So bad debts account, debit side, write your information. Information on the debit side, as we said before. Remember, pause the video and take your notes, right? We are continuing. Bad debts, so this is the next point. First point, bad debts are expenses. Second point, bad debts decrease the amount owed in the receivables account. So bad debts decrease the amount owed in the receivables account. The receivables account is therefore credited with the bad debt written off. Why credited? Because accounts receivable is an asset. When an asset increases, it is debited. In this case, a bad debt decreases the asset. So therefore, it will be credited to show the decrease, right? So you will go in the accounts receivable account, and on the credit side, you are going to write the information about your bad debt. How much was written off for that receivable in terms of bad debts. And this is what the account would look like. Credit for us, I have it in green. So you're going to come on this side of your accounts receivable, which is an asset, and you're writing it on the credit side because bad debts decreases the asset. And when you decrease an asset, credit side. Think I've emphasized that enough, right? So we're going to explain further with an example, and we have example 1. Receivable amount owed of $1,000 is written off as a bad debt. How much was owed? $1,000. How much was written off? $1,000. So what are the journal entries? Whenever we say journal entries, what we're talking about is which accounts are debited, which accounts are credited for the particular transaction. And always remember, because of double entry, there must be at least 2 accounts. Okay? And one must be a debit and one must be a credit. Always. Okay, so that is the question that we're asking. Which account is debited? Which account is credited? Now, what happened in the transaction? 2 things happened. A bad debt was written off, and because the bad debt was written off as an expense, the receivable amount was decreased. In terms of what you mean by receivable amount decreased, it means that that receivable or debtor does not owe that money anymore. They owe less than they did before. How much did they owe? $1,000. Because they cannot pay it and we are writing it off, the business is writing it off as an expense, a bad debt expense, it means that they don't owe that $1,000 anymore. So that amount owed is decreasing or going down or reduced. Okay? So the 2 things we said, bad debts expense. So that has occurred. We're writing off a bad debt. It's an expense. What do you do with expense accounts? You debit. According to your double entry rule, you debit. So that means that your debit account, or the account that you debit for this transaction, is going to be your bad debts expense. And how much is the bad debts? $1,000. So in accounting language, this is telling us that there was bad debts of $1,000 written off. Okay? The next account affected would be your receivable. So whoever that debtor is who owed the $1,000, if they give you the name, it would be his account that you go into. Because they didn't give the name, we are just going to put accounts receivable. Because he no longer owes that money because it's been written off, that means as an asset account, we are going to go on the credit side. So we're going on the credit side, accounts receivable, $1,000. And there you have your 2 journal entries, bad debt expense, debit $1,000 because it's an expense and you debit the expenses, and credit to the accounts receivable, $1,000. Because it's an asset account that is being decreased. He owes less. And this will be your transaction. And if they asked you for a narrative which just describes what happened in normal language, to record bad debt written off. Simple, straightforward. Okay? So that is the journal part of it. If you remember your accounting cycle, then you would remember that you go to the posting to ledger or the T accounts. So the 2 T accounts that we are going to do would be your bad debts and your accounts receivable. So we are going to start with the bad debts account. Remember, bad debts is an expense. According to your instruction here, which side are you going to go on? The debit side. So your instruction is to go in the bad debts account on the debit side. And you see, as we go on the debit side, I'm in my blue area. Debit side, you're going to write the information. If we had a date, you would write the year, the date. My example doesn't. Details. your details will always be the account that the opposite was done to. In this case, let me make it even easier for you. You only have two accounts. If you're in the bad debts account, that means it will be the other account, which is the accounts receivable, will be your detail. Right? So let's stick to the nice easy for this one. You have two accounts only. Nice and easy. You're in the bad debts account. Your detail is going to be the next account, which is the accounts receivable. And how much it is for your bad debts? $1,000. So as I said there, $1,000. Or you can just remember, how much were your bad debts written off? $1,000. So that is how much is going to go into your bad debts account. Now for the accounts receivable account. First thing that you have to do before you even put in the transaction, which is a bad debt that is written off, is you're going to have to show how much did that person owe in the first place. Because you can only write off something if they owed something in the first place. So their account should have a balance, and that balance would tell you how much they owed. Now remember, accounts receivable is an asset, and an asset is which account? Is it a debit or a credit account? So which side should the balance be on? Assets, debit. So that means that your balance owing should be, at the beginning of the period, should be on the debit side. And in our example, what color? That is simply the blue side. If you don't have colors, which you would not for the exams and all that sort of thing, look, it's stated here. This is always your debit side. So you're going to come to your debit side, and the beginning of the period, you're going to have balance brought down. It could be BAL brought down or BAL brought forward. So balance brought down, and you just look at how much was owed. The amount owed was $1,000. So your balance would be $1,000. Okay? Now that you have put that in, now you can go to your transaction and you can write off your bad debt. And which side did this say to go on? The credit side, which in our case is the green side. So we go on the credit side. If there was a date, we would put the date. The detail is the next account. We're in the accounts receivable account, so that means your detail will be the other account, which is bad debts. Also, because it's obvious what you're writing off, bad debts. So what word should be there? Bad debts. Okay, and then how much is the bad debts that is being written off? $1,000. And there you have just finished, and this is what your accounts would most likely look like. Right? If you just have that they write off the entire amount, this is what you would see for your accounts until at the end, which we are going to reach, we transfer the bad debts to the income statement and we balance off the accounts receivable. Okay? So you will take this down in your notebooks, and we're going to go and do another example. So, for example 2, the receivable owes $3,000. One time, you know that is your balance, right? Remember, that is your balance brought down. How much he owes? $3,000. In this case, he's actually able to pay something. He's able to pay $2,000. So he can pay that. But what happened to the remainder, the $1,000 that he cannot pay? We will just, as the business, we decide we're going to write off that amount as a bad debt. Okay, so basically, we have three things that happen there. From this information, what we can tell, how much did the receivable owe? In total, $3,000. How much did he pay? $2,000. How much therefore did he write off, how much did we write off as a bad debt? The remainder, 3,000 minus 2,000 means that he was unable to pay $1,000. So that is the amount that we wrote off as a bad debt. Okay, so those three things happened. How are we going to put that now in accounting language? It will be to decide which accounts you debit, which accounts you credit. Okay, so you have debit. Let's take how much he paid, right? So the first thing he did is he paid. Let's just look at it that way. Whenever he pays money, we receive money. Remember, we always have to look at things from the business's point of view. Since we are receiving money from him, that means that's an asset to us. We're going to debit that. So I like to put bank. If you put cash, you will still get it correct. How much did we receive from him or her? $2,000. So in accounting language, you see debit bank $2,000. What that means in normal language, the debit means that our bank account increased by $2,000. So we received $2,000 cash in bank. Simple. What else happened to do is the remainder was written off as a bad debt. A bad debt is an expense, so you debit expenses. So you're going to have another debit. It's going to be bad debts. And how much was your bad debts written off? $1,000. So let's just stop again and interpret the information. From these two things, let's interpret it in normal language. As we said before, when you see debit bank 2,000, it means that money in the bank increased by $2,000. When you see debit bad debts expense 1,000, normal language, we wrote off a bad debt. How much was the bad debt? $1,000. What is it going to be put in the income statement as? An expense. Okay? The credit. What was the next thing that happened? So we talked about what happened with our bank account. We received $2,000. We talked about what happened with the bad debts. We wrote off $1,000 in terms of bad debts. But what happened in terms of Mr. Receivable or Mrs. Receivable or Miss Receivable? What happened in terms of that debtor? That debtor owed $3,000. Of that $3,000, the person paid $2,000, which means that they owe $2,000 less because they paid it. So you're going to have to credit the receivable $2,000. But what also happened, besides the fact that they paid that money, is the remainder was written off as a bad debt. So along with owing $2,000 less, they also owe $1,000 less because we wrote that off as a bad debt. So in total, that receivable owes $3,000 less. The $2,000 he paid and the $1,000 that was written off as a bad debt. So that means that as an asset, it's decreasing. So you're going to go on the credit side, credit the accounts receivable, and how much in total? $3,000. Right? So this is your journal. In this case, you have two debits, one credit, but you must always have debits and credit. And the next thing, remember the accounting equation, your debits must be equal to your credits. So debits would be 2,000 plus 1,000, which is 3,000. Credits would be 3,000, so we know we good. Perfect. Now we move on to the accounts and posting to the accounts. So in this case, I decided to start with the accounts receivable first. And the first thing that we need to put or we need to disclose for our account would be the balance at the beginning, right? So we had a balance. How much did the receivable owe? he owed $3,000. So your balance on the debit side, because it's an asset once again, would be $3,000, right? So we have our balance. This tells us that at the beginning of the period he owed 3,000. Now we can go and we can write off the bad debt and also show that he paid some of the money. All right. What does the instruction say for the accounts receivable account, which is the account we are doing now? They said to go on the credit side. So we go on the credit side and we're going to write the date if we had a date. And then the details will always be, if we are on the credit side, it will be whichever accounts are debited. So the opposite. So we are in the green area right now. So the details are going to be which accounts, in their accounts, we entering in the blue area. What you can do is you can see here, we have two accounts that are being debited in this transaction. So that means these two accounts, the bank and the bad debts, are going to make up our details for your accounts receivable account. That is the explanation. What you can do is do this enough and it just goes into your mind. You will memorize it. You will always have on this side, whenever the accounts receivable pays money, it will be credit side. We will write it down on this side because it's decreasing the amount that he owes. So you will put bank, because that's the first detail, and how much did he pay us, or how much did we receive from him? $2,000. And then there's the bad debts, which is the next account that is debited. So bad debts, and how much was the bad debts figure? $1,000. So let's just take some quick time here now to interpret this account. Okay, accounts receivable is an asset, which means anything on the debit side means there was an increase. What is an accounts receivable? Somebody that owes the business money. So anything on this side, that shows that there is an increase in the amount that he owes. So how much did he owe at the beginning? $3,000. Okay, so nothing had changed. This was your balance from the previous period. You started off the period owing $3,000. He paid, which means he's decreasing the amount. So you go on this side. Everything on this side shows that there is a decrease or reduction in the amount that he owes. This one says bank $2,000. What it shows is that he owes us less because he paid some of it. Okay, so he paid the $2,000. That means that he owes us $2,000 less. How did he pay? By check. If you see bank, if you had cash, then we would be assuming that he paid by cash. But what is most important? He paid. But as well as paying, what does this also tell you? That there were bad debts written off. So how much were your bad debts? You can see it right here, $1,000. That is what you would interpret here. He paid us some and he had the rest written off. How much did he pay us? $2,000. How much was written off? $1,000. If you want, you go back here and you read it and you would notice that it is the same information, same meaning. We just interpreted it in accounting language. Okay, so that is for the accounts receivable. Let's go on to the next one, which is your bad debts expense. Bad debts is a expense, so, or an expense, so it's a debit. But like looking at our journal, you're looking for bad debts because it's the bad debts account. Bad debts, which side is set to go on? Your debit side. So you go on your debit side, and the information, since you're on the debit side, your detail will be the account that was credited. Or just remember, for bad debts, you always write your receivable on the debit side, right? If that is easier for you, just remember it as that, memorize it. Bad debts, the information you would see in your bad debts account would be the name of the receivable that you're writing off the bad debt for. Okay? So accounts receivable, and how much once again was your bad debts? Your bad debts was $1,000. That is how much you wrote off. So that is how much you're supposed to see in the account. Right? So you could see accounting language, bad debts, 1,000. Who was the person? Very simple. This is your second example. And what you would notice, it's the same, the account looks the same, except for one thing. There is an additional entry, which would be bank. But for bad debts, if there's a partial payment, this is always how your accounts receivable would look, with a balance, bank, bad debts, and then your bad debts account, always on the debit side, the name of the receivable. Ready for the next one? We have one more. This is example 3. The receivable this time owes $5,000, but is only able to pay 40 cents on the dollar. What that means, don't get scared. What that simply means is 40%. So if you see the question given to you like this, 40 cents on the dollar, it just means 40%. Or you just multiply the 5,000 by 0.40, and that will give you how much was paid. Nice and easy, so don't get afraid or anything like that, okay? Just like the other example, the remainder that is uncollectible, we the business, going to write it off as a bad debt. How much is your bad debt? 60%. That's the remainder. If you paid 40%, that means the rest of it, 60%, is the bad debt that was written off. So what are your journal entries? Just like the last one, you will always debit bank. So we're going to put bank. We received how much money? 40% of the 40% of the $5,000 owed would be $2,000. So we received $2,000 from him. He doesn't owe us $2,000 anymore. But in addition to that, bad debts, which is an expense, was also debited. The remainder, which is $3,000, written off as a bad debt. And as a result, the accounts receivable does not owe the entire amount anymore, because he paid the $2,000 and the $3,000 was written off. So therefore, we credit his account to reduce the amount that he owes by $5,000. Then you go to the account. Let's do the accounts receivable again. You start with your balance, which is on the debit side. So you always have your balance brought down. How much did he owe? $5,000. So you're going to have your balance brought down on this side. And then you're going to go to the credit side. By now, this should be, you're not thinking about it anymore. You're not even following instructions. You're just so accustomed to it. Balance on the debit side. You go to the credit side. You put the date and you put your bank. And how much did he pay? $2,000. And then in addition to that, how much bad debts was written off for him? $3,000. And this is the information for the accounts receivable. You're going to the bad debts expense, and expense always on the debit side. And what did we say to just get accustomed to? On the debit. On the debit side, you're going to have the date and the name of the accounts receivable. If you don't have a name, you put accounts receivable or debtor. And how much was the bad debt? Bad debt was $3,000. So you must have the amount for the bad debt there. If you have $5,000, what you are saying is that you wrote off $5,000. And that is not what they told you. Okay? That is definitely not what they told you. And that is not what we worked out here either. It is very clear. It is $3,000. So in the account, you must see $3,000. And that is a third example, and you would see it's there very, very clearly for you in terms of what you would usually see for the account. So you would pause, you can take that down. So we're going to go to our workbook. These are just the journals, and the newest thing would be for the income statement. When you transfer two income statements at the end of a period, to transfer means to take out something. So if your bad debts is an expense and you debit it when it increases, then to take out the amount to transfer to the income statement means you will just go on the credit side. It will be best to explain that with an example, but this is basically what happens. Your bad debts, you have your receivable. That is what we have been doing all the time. So you have your receivable and you have the amount. In our example before, it was $3,000 was written off. At the end of the period now, when we have to transfer that to the income statement, you will go on the credit side to take it out. You would put whatever the date is, income statement, to show that you are transferring it there. That is where it's going. And how much is your total bad debts? $3,000. So this is the only additional part now for your bad debts account, and this is how it would look. With on the debit side, your accounts receivable, and on the credit side, income statement. So in your books now, we have Ricky Martin, and yes, J. Lopez is Jennifer Lopez. So we have those two. Ricky Martin is the name of the business, and then we have J. Lopez is our receivable. And what we did is we gave you the journals. And what does this show? It shows that we received $7,000 from J. Lopez. We wrote off $3,000 because she was unable to pay that amount. So we wrote it off, or Ricky Martin, we represent Ricky Martin, wrote off that as a bad debt, $3,000. And therefore, J. Lopez owed $10,000 less, because she paid $7,000 of it, and the remainder, the $3,000, was written off as a bad debt. When we come to J. Lopez account, the only thing we gave you was the balance. This shows that this is how much she owed on the 1st of April. So at the beginning of April, she owed $10,000. So what does this say? If she does not owe this anymore, that means that she owes us nothing. Right, so that is the information there, but we are going to put the information in an account. So here we have, this is our journal. Yes, it's a bit smaller. We have our balance already. So we are going to do the transaction for J. Lopez. If you remember what goes on the credit side, because that is the side that we are going to go on, bank and bad debts. If you still have to work it out, J. Lopez said to go on the credit side. So we go on the credit side, and the details will be the two accounts debited, which would be bank and bad debts, which I really do suggest that you kind of learn it off. Even though you know the explanation for it, memorize it so that you don't have to keep on thinking about it all the time and probably confusing yourself. So you have your balance brought down on your debit side, going to the credit side, and you're going to put the date, which is the 1st of April. So we actually have the date 1st of April. And the two accounts, the detail would be bank and bad debts in any particular order. So you have bank, and how much was the bank amount? $7,000. And then the next one was 1st of April, bad debts, $3,000. Right, so we went on the credit side for J. Lopez, and we put those two transactions, which shows us we received $7,000 from J. Lopez, and we wrote off bad debts for J. Lopez, $3,000. Okay? Then we will go to the bad debts account, and since it's an expense, we put it on the debit side. Plus it says here, look, it's highlighted, it's said to go on the debit side. So we're going on the debit side, and you should, after practice, have it memorized. What is your detail? Besides it being, you knowing now that it is the account that was credited since you're on the debit side, even easier. Bad debts, your details would be accounts receivable, whatever the name of the person is. So in this case, they gave us the name. Who is our receivable? J. Lopez. So you're going to write J. Lopez. And how much was the bad debt? Seeing it highlighted here, the bad debt was $3,000. No other amount goes there. It's the amount for the bad debts, because that is what the account is. It's a bad debts account. Only bad debts going inside of here. So $3,000, and this will tell you we wrote off $3,000 for J. Lopez. See how specific it is, how detailed. When did that happen? You see it right here on the 1st of April. Good? So this will be your bad debts account. This is the only transaction that we have for it right now. So we will come to the end of the period, because we said here, balance and close off the accounts at the end of April. So let's just stick with the bad debts. The end April is only 30 days, so it will be the 30th of April. Where are we sending it to? Income statement. So you're going to write income statement. And what is the total figure? $3,000. For your accounts receivable, that is not a close off, it's a balance. So we're going to balance it, and you would see that both the debit side and the credit side has the same total. Oh, let me just close off my bad debts there, so you see the two double lines. Right? Now let us go to J. Lopez, and we will put our totals there. And debit side, $10,000. Credit side, $10,000. So it's equal, balanced. There is no balance carried down because J. Lopez owes us nothing. Right? She paid $7,000. We wrote off the remainder $3,000 in terms of bad debts. And this is what your accounts would tend to look like for bad debts. Every time there's a bad debt, we were not asked to do the bank account, but if you do the receivable account, you will have your balance brought down on the debit side, and then you will have your bank and bad debts on the credit side, and you close it off. And then for your bad debts, on the debit side, you would have your receivables with how much your bad debts were, how much you wrote off for the particular receivable, and then on the credit side, you will transfer it to the income statement at the end of the month. Good? So this will be your assignment, and we can correct that one in class, but hopefully it should be easy for you. We're not going to do it in this video because that will be giving you the answers. Go and do an attempt to do the transaction after everything that we have done here. That's the end of our lesson for today.